Welcome back to All Things Money. I'm David Blain. In this segment, we're going to take a look at some of our viewers and listeners' email and answer some of those questions. Before we do, I wanted to touch real quickly on currencies. We talked a little bit about currencies in this show and previous shows. The currency market, which is simply you hear about the dollar, the euro, the yen. These are different countries, the monetary unit of monetary measure that they use. And the currency market is actually the largest market in the world, meaning that on a daily basis, more dollar volume changes hands in the currency market than the stock market, the bond market, the oil market, any other market. It's the largest market in the world. And so when we talk in terms of currencies, it's always relative. That if the dollar is up or the dollar is down, it's always relative to another currency. So if someone says, well, the dollar was up today, your first question should be, against what? Because it doesn't just go up or down like a stock. It has to go up or down against another currency, such as even in the same day, the dollar could be up against the euro and down against the yen. And so you really have to be careful when talking about the dollar up or the dollar down, about what you're talking about. The other term you'll hear is strengthening and weakening. So strengthening means that the dollar is strengthening usually against a basket of currencies, and if it's weakening, it means that the value of the dollar is declining against other currencies. So what does that have to do with investing? Well, as an asset class itself, currencies usually have a low correlation to stocks and bonds. They tend to go up or down at different times. In fact, in the crisis of 2008, the dollar appreciated significantly, as well as the yen was a reasonable place to sort of hide out till the crisis was averted. There's a number of ways to invest in currencies: futures markets, as well as exchange-traded notes and exchange-traded funds. We generally recommend that unless an individual really knows what they're doing, that they avoid trading in currencies. As the world's largest market, you have extremely sophisticated traders out there that this is what they do. They sit in front of a screen all day and trade currencies. And so unless you really know what we're doing, we encourage you to not get involved in this. However, we will from time to time ourselves take a position in a currency. They can be very useful, especially in times of economic distress. Or the euro. I mean, the euro at some point, unless it collapses completely, will recover, and it may lead to some interesting investment situations. So anyway, that's just a little bit about currencies. We want to get here to a couple questions. Our first question comes from a listener about the possibility of the U.S. Treasury losing its AAA bond rating. And so the short answer I would say is no. I don't think the U.S. Treasury is going to lose its bond rating. Well, first of all, what is a AAA bond rating? There are various rating agencies like Standard & Poor's, Moody's, Fitch. These companies, they put ratings on bonds, whether they be corporate bonds, government bonds. They go in and they look at the finances of the entity, and they put a rating on it. And so the highest is AAA, and then you have AA, single A, and on down into rating level D, which means the company is in default and they're not making their interest payments. So a lot of people around the world rely on these ratings when purchasing bonds. It's very difficult to rate bonds. There are many more bonds out there than there are stocks, and so we find that these rating agencies provide some useful information. So we don't think that they're going to cut the rating on the U.S. debt anytime soon. Doesn't mean that there aren't problems with the U.S. monetary and fiscal policy. It's just that we don't think they're going to cut the rating. And in times of panic, people are still flocking to the U.S. Treasuries around the world. Our next question comes from a viewer in Fairfield Harbor who watches CNBC all the time, which I don't recommend that you do. And he was wondering what it means by EBITDA. You heard the term EBITDA. It's EBITDA, and it's shortened EBITDA. And what does this mean? EBITDA is simply an acronym for earnings before interest, taxes, depreciation and amortization. And you hear it a lot of times by some of the pundits on TV. They say, oh, well, geez, EBITDA went up or down, or, Microsoft EBITDA, So what are they talking about? It's simply a shortcut method of looking at the earnings of a company before accountants take into account the deductions for interest, taxes, depreciation, and things like that. These particular people think that EBITDA is a better way of looking at a company's earnings before the accountants get a hold of the numbers and massage them. Personally, I think if you're looking for a number, sales is a much better it's very difficult or it's much more difficult to manipulate sales than it is earnings. As you go through the earnings statements of a company, the first thing that comes in is sales, and there's only so much manipulation you can do of that other than outright lying. It comes to a decision of when do you book the revenue, when the sale was made or when you receive the money. But it's much harder to manipulate that. By the time you add in your deductions and you get down to an earnings number, a lot of the complaints people have is that it's very easy to manipulate the numbers. So if you're looking for a number that is not as easy to manipulate, I prefer looking at sales, because when you're talking about EBITDA, you're talking about earnings. And if you're saying earnings before taxes, interest, depreciation, amortization, well, what do you have? You're essentially saying that the interest that a company pays doesn't matter. You're saying that the taxes that the company pays doesn't matter. Depreciation, when a company buys a piece of equipment, they don't take a deduction for the whole piece of equipment. They deduct a certain percent over the life of that piece of equipment. And so you're saying that, the purchase of equipment doesn't matter to that company. So I am not a big fan of EBITDA. I understand why it's there. I understand that it helps smooth out the earnings instead of looking at numbers after they've been massaged. But once again, if you're looking for that type of number, I prefer to go up to the top line, which is sales, to determine whether a company, how a company is growing, how a company is progressing forward. But EBITDA does have its usefulness. It's just not, I'd encourage you to take a look at other measures of a company rather than just relying simply on EBITDA. Well, that's about all the time we have for today. If you have any questions or comments, our email is allthingsmoney@dlblain.com. For All Things Money, I am David Blain, and we hope that you'll join us next week.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.